Again, let's kind of go back. What is the financial manager responsible for? Investing decisions. They're in charge of trying to figure out what assets the corporation needs in order to do the things that we would like it to do for us. In addition, they obviously look at financing. They determine what the corporation's policy is with respect to the borrowing of money and the using of shareholder money. And then ultimately, they have control over the analysis of cash management to determine that the company has enough cash to do the things that need to be done to ultimately to do the strategy to move the corporation forward. So now we're going to switch gears just a little bit and talk about something called the goal of the firm. And I like to think of this a little bit more like a benchmark, if you will. Shareholders will agree that if management makes decisions that maximize the stock price, they feel like they're better off. In fact, I think if you were pretty cynical, and I think I'm a fairly cynical person, that's really the only thing shareholders are interested in. Shareholders have an investment in the business. They have an ownership interest. Their one and only goal, their one and only hope is that the value of that asset, whether it be through the distribution of dividends as a payback or through the increase in value of the company, that is their one and only goal. So that should ultimately then be the primary goal of financial managers. Now, there are a lot of goals, though. There are a lot of things that we can use as variables. We could talk about maximizing profits and costs, or minimizing costs, maximizing market share. I mean, all of these things are certainly very important goals. They're objectives that we would like to hit. But I think in the end, the question ultimately is, really, what should management use as the variable to make a decision? When they're doing this, what outcome should have the highest priority? And from the perspective of ownership, owners have the concept, the idea that they want to see the value, the wealth that they have invested. They want to see this grow. The two primary ones that we typically talk about are maximizing profit, and then, of course, what we've been talking about, maximizing shareholder wealth. So why is maximizing profit not our highest priority? Well, for several reasons, and some of these will become, I think, crystal clear as we work our way through the class. But essentially, profits are backward looking. Decisions in the company are made looking forward, not looking backwards. Profit is dependent on accounting principles. It doesn't fully consider cash flow timing. It doesn't move money back and forth in time as we need it to move, so we can make proper decisions. Quite frankly, it totally ignores the concept of risk, where maximizing shareholder wealth is the proper benchmark. Modern finance claims this as the gold standard, if you will. So maximizing stock price, not profits, should be the primary goals. And I guess when you get right down to the bottom line, stakeholders are referred to as residual claimants. They give us money, and we return them money only if there's something left over. They bear the greatest amount of risk on invested dollars in the company. So they're not going to take on these risks unless we can provide them some form of return. They want to increase their wealth. Another topic to discuss refers to which in the corporate research world is talked about as being an agency problem. Managers tend to act in their own best interest rather than in the best interest of shareholders. This is what's referred to in economics as somebody as being a rational decision maker. There's nothing really wrong with this. This is the way people think. The challenge is there's a conflict. Shareholders want managers to only do those things that increase wealth, increase the stock price, but sometimes managers want things that increase their personal wealth. So how do we tie this in to decision making so that managers do what we want them to do? How do we measure performance, in other words? Should we use earnings per share, net profit margin, a concept called economic value added? I mean, how should we measure performance? And the answer is there's no research that's been done that shows us what is the best way to measure performance so we ultimately understand whether managers are doing a good job or not. So what can we do to help managers to make them think more like owners? Well, we can do things like corporate control or have an understanding of corporate control. A takeover can frequently happen if management doesn't do a good job. In particular, we have leveraged buyouts where a small group of owners gets together. They get tired of management. They don't feel like they're doing a good job. So they take over the company. Of course, they fire the managers. This actually brings up a topic or a terminology of something called a hostile takeover. A hostile takeover is one in which the managers of a company do not want the merger to take place. So you need to ask a question. If the managers don't want a merger to take place, what's their motivation for that? Well, their motivation for it is they know that they haven't done a good job and they're probably going to get fired and lose their position. That's a hostile takeover. A friendly takeover is one that management team wants to happen. Again, what could their motivation be? Well, there's lots of reasons why mergers happen, but in this context, you might then just raise an eyebrow saying, well, in one case, they don't want it to happen because they know they're going to get fired. Why would they want a friendly one to happen? In the friendly takeover, maybe they're not going to get fired. Which one's better for the current shareholders? And there's lots of arguments that the hostile takeover is actually better for the owners of a corporation than the friendly takeover. What about an audit function or an insurance arrangement, right? We ask, the SEC requires companies to audit their books. However, as a sidebar, as an additional benefit of having our books audited, managers now need to sign off on the accuracy and the quality of the information that they give us. So this should give us more information about both good and bad things that are happening inside the company. And finally, I guess we can talk a little bit about compensation. How should we pay managers so that they think most like an owner? The best way, quite frankly, is to do this is just to pay people in stock. So when you go to get your paycheck, you open your envelope and there you have 15 shares of stock. The challenge with that is, how do you buy groceries with stock? You don't. You have to convert it. So there are some challenges with how we pay managers. One of the tools that we have at our disposal are options. And there's lots of different options, but I think most of us have heard about employee stock options. An option in this context is essentially the right to buy stock at a certain price within a certain period of time. What this does is creates two places where you can go to buy the stock. So here's an example. You have an option to buy a share of stock for $50. A piece of paper says, anytime you want, within a certain period of time, you can give us $50, we'll give you a share of stock. The challenge is the current stock price at the stock market's $35. So if you wanted to buy stock, you certainly wouldn't pay 50 if you only had to pay 35. So you'd go to the stock market. However, if we've been able to increase the share value, make the stock price go up, what happens if someday the stock price is $65 and I have an option for 50? Would you rather pay $50 for a stock or 65? Well, obviously you'd rather pay $50, and immediately you could sell the stock, and in this case, you'd have a $15 option or profit on the transaction. So let's just take another step forward and let's think a little bit more about some terminology. Right? We want to talk about the stock market in general and what the stock market provides and creates for us. The stock market creates a place for shareholders. Number one is to have liquidity. So that is, it's very easy to buy and sell assets at a price that is created within this mechanism. So it helps us create prices that, quite frankly, through something called the efficient market hypothesis, we can have some confidence that that price adequately represents the true value of the company. Liquidity, on the other hand, just gives us the ability, number one, to become owners, but also to become to get out of the ownership business should that be something we want to do. The final context or piece of terminology we want to talk about in this chapter has to do with how do corporations ultimately get money? And we have two kinds of markets, if you will. We have something called the primary market and then the secondary market. The primary market is when a corporation issues shares for the very first time. These are could be referred to in two different ways, I guess. The first way is through something called an IPO. In an IPO, it's when a corporation issues stock for the very first time. We've had several of these over the past years that have been very large. Visa, Google, Facebook, all of these have been what are referred to as primary market transactions. The current owners of the corporation take their investment and ultimately provide access to other owners. So it's a way to get money, it's a way to increase the size of the corporation, but it's also a way for the founding fathers, if you will, to ultimately gather some money for their efforts and their risk-taking while the company has been growing. The secondary market transaction happens after the corporation has been created, and this is where investors trade between investors. The key difference between these two is who gets the money. In the primary market, the corporation gets the money. In the secondary market, the money trades hands between investors. That is the end of chapter 1. A little bit of a review. We'll see a picture of where we're moving forward. And we will talk again in chapter 2 when we get down to talking about some analysis of the company, of the corporation.